Welcome to Investors Insights. Our topic today is yields, chills, and thrills. Will we see yields go up in the following weeks to come? Will we see the consumer confidence start to chill? Will we see the market react excited and thrilled about possible tax increases? We're going to discuss all of that today and continue the conversation throughout the week on our social media. So please follow us on all those, as well as other vlogs to come during the week. Now, who's going to have that discussion with me? Adam Van Zant, Bobby Norman, and Trey Booth. And gentlemen, I really appreciate all that you did over the weekend and the research you did. Thought it was great. So Bobby, you've got to start us off because you hit us first thing this morning saying that in the bond market, we might see yields go up some. Is this true? Possible?
Yeah, Greg, we're following yields carefully. And despite the run of lower economic reports over the last 6 weeks, punctuated with a big payroll miss 2 weeks ago, yields have actually held their own and are on the doorstep of pushing through the important 1.38% level, as you can see in this chart. And it's important to note that the resiliency from yields, despite the weak data, likely suggests that much of the growth scare has already been discounted. And so above 10-year yield above 1.38% will be a breakout. But today, we really want to focus on, on the taper tantrum or the rate tantrums. There have been a lot of worries about a rate tantrum, so we want to address that. We still expect yields to drift higher between now and year end, but the catalyst for a more painful tantrum that could bring 10-year yields above 2% will really have mostly faded by late September. And so we expect to see the 10-year yield make a fairly muted move up towards 1.8% before the end of the year. But progress above this level and above 2% will require greater fiscal cooperation in Washington. As mentioned last week in the vlog, we are entering the Super Bowl of policy actions impacting financial markets.
You're correct.
With such a large number of issues that need to be dealt with in the month ahead, next couple of weeks: budget, infrastructure, fiscal cliff, debt ceiling, Biden's $3.5 trillion spending package, tapering, Fed reappointments. And so also, there's over 15 trillion. I said that right, 15 trillion in negative yielding sovereign debt globally. So that will also keep rates from breaking out too high and avoiding this tantrum that's been talked about.
Bobby, great information there. And then Trey, you interjected on us today a concern possibly about consumer confidence. Again, yields, chills, and thrills. Can the consumer continue the strength that we've seen over this year, or will they start to chill as we start to enter fourth quarter of 2021? Talk to us a little bit about that.
Yeah, thanks, Greg. So our research partners at Strategas provide us with a very, what I thought, informative chart showing the correlation of consumer confidence in the trailing 12 months of the S&P 500 earnings. It's amazing how the spikes in confidence coincide with spikes in earnings. And so while they're not 100% correlated, you can see on this chart that the big moves really go together. And so we've had very strong consumer over the last 12 months coming off of the dip of COVID. And can that consumer continue? Because that's also coincide with a big run up in earnings. And that may be the canary in the coal mine. The information we get on Friday, the consumer sentiment out of the University of Michigan, may be an early indicator of the consumer weakening, or could the consumer be brushing off all the bad news out of DC, all the concerns about recent surges in potential global coronavirus and the U.S. potential surges? Is the consumer maintaining the strength? We've seen the U.S. consumer being very resilient over the last 2 years, and that may continue. And if it does continue, then we should expect higher earnings from here on out, or this could be the first crack in the beginning of a chill in S&P of earnings growth.
Well, and let me ask you this question, Trey, from the standpoint, if we start to see yields go up and people start to think maybe mortgage rates and those kind of things might go up, and number two, from the standpoint, tax proposals are coming out that their taxes might be going up. Could that psychologically have an impact on the consumer?
Absolutely. We've seen in the past that mortgage rates especially have a very large impact on U.S. consumers, and because that also bleeds into consumer debt and consumer credit to credit card yields and other parts, home equity lines of credit, and then definitely the taxes, because that people perceive that to impact their excess spending, which really could go to the bottom line.
Bobby's talked about fundamental analysis. You've talked, Trey, about fundamental analysis. And so what about the technical analysis? Because at Five Pine Partners, we do both. Adam, talk to us. We're still seeing strength in the market, although last week we saw some pullback as well. So talk to us about that.
Thanks, Greg. You alluded to it. So last week we saw some volatility in the market, a little bit of pullback. S&P 500 Friday close came in at 4,458. That pushes our new resistance level to 4,490 with a new support level of 4,430. We also see a 50-day moving average sitting at 4,424. So that kind of correlates with that support line we were looking at. We also talked about a 4,500 resistance level for the end of the year. So Trey, you alluded to consumer confidence. Also, Bobby, you alluded to yields. So that's something to look at on the fundamental side and to see if we can keep pushing up to hit that resistance level by year end with the last quarter kind of approaching us.
A lot of moving parts as always that we see, but trying to anticipate and navigate through it using a combination of technical analysis as well as fundamental analysis and tying in our clients' financial blueprints to make sure they're on track in achieving their goals. So as our company saying is, every day we're here striving to make sure that our clients live a better, richer, fuller life. And so with that, despite all the noise, despite all the volatility, we want to make sure that we're on track and we want to keep you updated. We're frustrated educators, and we believe the more knowledge we give you, the better you understand the moves we make in the markets in relation to your financial blueprint. We're going to keep you updated. We greatly appreciate the way you've shared our blogs with others, and we hope you have a great week as we continue on the month of September and head for fourth quarter of 2021. Thanks.